Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Letters and the Banking on Profits Report, coming to you from a scorching day down here in Central Florida. Now, of course, the weather's one of the reasons I moved down here. I love the hot weather, but it's so hot down here today that I took the dog outside and threw the ball. She went and scratched on the door so my wife would let her back in the air conditioning. So it's a little warm down here. Going to be warm tomorrow as well. We're going to head over to the beach at New Smyrna. There's a sandbar over there where I just take my chair and a book and I sit out there in a couple feet of water all day and absolutely love it. Best way to beat the heat down here. So I'm sending you out this video on Saturday rather than Sunday. Anyway, very complacent week in the stock market, just kind of flattish action. Nobody really seems to care about much of anything. There was a disastrous GDP report, down 2.9% revision for the first quarter. Nobody really cared. Still flashpoints in Iraq and the Ukraine not filtering into the markets in any way, shape, or form at this point in time. I think that those traders that are not in the Hamptons have been down at the corner bar watching the World Cup all week. It's the only explanation I can find for volatility being so extremely low right now. Flipping through Barron's this week, it's easy to see how individual investors could be completely confused right now. And you've got one strategist pointed out in Barron's that he's bullish on stocks because the earnings yield of the S&P 500 is still 5.2% according to his calculations. And then on the same page, Nobel Prize winning economist Robert Shiller's right there saying, hey guys, markets have never been, the S&P 500 has only been this expensive 3 times in history. The Cape-Shiller PE ratio was higher than the current levels only in, you ready for this one, 1929, 2000, and 2007. None of those were particularly excellent times to be purchasing stocks. Now, one of the big arguments I've heard for the past couple weeks for just willy-nilly buying of stocks is that we're going to have this super strong economy and it's going to be led by the housing markets. And indeed, if you looked at the headlines this week, it looked like, hey, that's starting to happen. Look at these great existing home sales numbers and this fantastic jump in new home sales. Well, okay, but if you actually read the report, the numbers were good. They were much better, but they measured against that disaster that was April. The numbers looked pretty good. Let's dig a little deeper. The existing home sales report, way above that nasty April and March, for that matter. 5% below last year's level, and in spite of that, prices are 5% higher. So that's not a particularly bullish year-over-year progression rate, in my opinion. The real problem, and I've addressed this before, there is no first-time home buyer in the marketplace right now, okay? That number is usually up around 40% of all buyers are first-time home buyers. Declined again last month. We're now down to just 27% of buyers being first-time home buyers. Remember, kids are getting out of college or moving into a career. Low-paying jobs are the norm right now, or part-time jobs. It's very difficult to get mortgage loans. They're staying at home. Trust me, I know. I got a 25-year-old here. It's hard working, trying to save his money, but buying a house is just a little bit out of reach for him now. And that generation's also not thinking about getting married and having kids and forming families as soon as earlier generations did, which is also keeping them out of the home purchasing market. They're more inclined to rent. Distressed sales of existing home sales were 11.8%. That's still pretty high. And all cash, which is kind of indicative of an investment buyer, was still 1/3 of all new purchases of existing homes. Again, compared to the month before, fantastic jump in new home sales for the month. It's a catch-up number, though, because if you look at the 5 months number, we have this fantastic month in May. But 5 years over the 5-month period, we're just about where we were last year. So that was just kind of a catch-up in demand a little bit. And again, entry-level buyers completely sidelined, not really present in the new home market at this point in time. If you look at some of the other numbers, building permits are down 6.5% year over year. So is the number of new homes under construction. Mortgage applications so far in June, and we got a couple days left in June, they're down 15% year over year. So I'm not a complete housing bear. I am a little bearish on the home builder stocks, and I think chicken shorts using put spreads on those would probably end up being a pretty profitable venture. I think housing's going to kind of bump along the bottom here a little bit, decrease in some areas, maybe firm up a little in some other areas of the country. But there's not going to be this massive wave of building and construction activity that leads us out of the current grinding economic morass that we're calling a recovery. So if your main reason for running out and buying stocks is because everything's going to get better, because we're going to see all this building activity, it's going to spur all this business, yeah, you need to rethink your approach to picking stocks, because I don't think that that's necessarily going to work very well for most people over the balance of 2014. Now, in the reading lists that I sent out this morning, and I send those out couple times a week. The international letter gets one on Wednesday, and the remaining letters get one on Saturday. And it's just a list of articles, reports, studies, anything that I've run across that I thought was pretty interesting during the course of the week. One of the best articles we sent out this morning was in Bloomberg Business Week, and it's about a private equity guy who was a Bear Stearns broker, and right around the time Kohlberg, Kravis, and Roberts started, he decided he did not really like living in the U.S. He was a Canadian fella, and he was going home to Toronto, basically. So Jerry Schwartz moved back to Toronto and started a private equity firm called Onyx. And to say that he's done well would be something of an understatement. The internal rate of return on this guy's deals over the last 30 years has been 28%. Even the worst of his funds that I looked at was started right at 2008, just as things just all fell apart, is compounding at 9%, which is pretty good given the higher prices of assets back then. Now, from our point of view, there's a couple of interesting things about this guy. I've often said that sometimes the right thing to do is nothing. And we're in kind of that environment a little bit today. There's a few things to do, not as many as we'd all like. Mr. Schwartz went from 1987 to 1990 without doing a single deal, stockpiling cash to take advantage of the recession that followed very shortly thereafter, 1991, 1992, and he was able to pounce on some very attractively priced deals. The firm is a lot smaller than, say, Apollo or Kohlberg, Kravis, and Roberts, and it gives them the flexibility, they said in the article, to focus on deals that have a little more hair on them and are therefore cheaper in valuation than some of the bigger firms can deal with because they're smaller companies. So, his most interesting comment was that he sees some positives. They're encouraging banks to cut back on some of the riskier lending that they're doing that's making some of these valuations and multiples we're seeing in deals get pretty high. It's up around 11 right now, which is a little excessive. So he thinks that we might see a little bit of a pullback there, and he says there's signs of a change, but that it is still very much a seller's market in most of the asset classes, industries, and sectors that he's looking at. We're finding pretty much the same thing. Not a lot of cheap stocks around. So anyway, it's a great article. It's in this week's Bloomberg Business Week. Just excellent article if you get a chance to read it. Lots of good takeaways. The firm's website is an education in and of itself, because I spent a little bit of time there last night as well. Now, today has been number crunching day. I've been huddled down in my office doing spreadsheets, going over all of the portfolios. We did 3 of the 4 major portfolios today, just crunching out the numbers, providing updates on the credit and fundamental situation at each company, the current price to book value, the current yield, and just giving everybody kind of an update on where we are on the individual stocks in the portfolio. Some really interesting discoveries today. Banking on profits, we went through that, kind of dug through all the numbers, looked at all the non-performing assets, got an updated spreadsheet out to subscribers. And by the way, folks, if you are a subscriber, don't know why it never occurred to me to do this before, but I sorted the spreadsheets for you this week in rank based on price to book value, so it's a little easier to figure out what's cheap and what's not. Now, in the banking on profits portfolio, we have 16 stocks that are screaming buys right now, regardless of your market opinion. Now, I keep my positions at about 1.5% each in the portfolio. Some folks are a lot more aggressive and get a little more invested than I do, but I like to own lots of them and keep my position size pretty small and keep a little cash around so I can double down if I need to. So 16 stocks, absolute screaming buys, trading well below book value. Of the 16 stocks that I call screaming buys, the average price to book value is 78%. The average equity to assets is still north of 12, and non-performing assets are right around 2%. These are quality banks with solid balance sheets and very soundly performing loan portfolios at 80% of tangible book value. Absolute screaming buys. There's 10 more that are they're right there. And if we got any kind of little dip in the stock market, of course, that might have been outlawed in the last few months, I'm not sure. But if we do get a little bit of a dip in the stock market, they're going to fall into the category where they're also screaming buys, and you'll be able to ramp up and get a little more fully invested in this small bank trade of the decade that I see developing. Took a look at the 10 tiny banks that we did in the special report, and they've done pretty well this year. They're actually beating the market since we put the book out. But if you look at the 10 tiny banks, 70% average price to tangible book value right now. Equity to assets is a little north of 12 once again, and non-performing assets were just right around 2 to 2.25%. So all the banks, good, sound financial shape. Now, of the 10, one has run up quite a bit and is now trading right at tangible book value. That one, take it off the buy list. I wouldn't pay up for it here. Once you take that one out, you got a portfolio there of 9 small community banks around the United States trading at just 67% of tangible book value. Given that the average deal price right now is 1.3 times tangible book value, and that number is just going to go higher in the years ahead, these are outstanding bargains. Now, in the income portfolio, we try to stay fully invested in that portfolio in order to provide the income that folks need. That's why they subscribe, was to get safe and cheap source of income. Trading about 1.08 times book value. We're a little bit more flexible in this letter, and we'll look at enterprise value to EBITDA and some other things, as long as those stocks have the yield and the dividend growth potential that we are in fact looking for in this portfolio. We use Piotrowski F-scores quite a bit to rank our companies in that portfolio. We have an average score of 5 at this moment in time. A whole bunch of them are 6 and 7, which is a great indication of strong price performance ahead over the next year. And the average yield on that portfolio right now is 7.1%. Not bad when the 10-year Treasury is earning 2.5% today. Now, in the deep value portfolio, we have 18 stocks in that portfolio trading below 75% of tangible book value. 22 are below 80% of book value. I've got 6 stocks in there that right now are trading for less than my calculation of their liquidation value. There's 4 of them that are trading at less than 75% of net current asset value. All of those are just absolute screaming buys. Now, I keep my position sizes small. I'm a lot more like Warren Schloss than Warren Buffett. I've got no problem owning a lot of stocks, and it's been successful and outperformed for many years, so I'll stick with it for now. A little too late to change at this point in time. And when you look at the stocks that are like cheap enough to you can go out and pretty much buy these things tomorrow, you've got a great mix of companies. You've got airlines, you've got a regional bank, you've got a bunch of energy related names, you've got some small real estate investment trusts, you got some tech, some retail, and even some shipping and mining stocks in the portfolio. So you got a pretty diversified mix of stocks that are safe and cheap enough to buy right now. Anyway, if you're not a subscriber, you should be. And we've got a couple special offers going on right now. If you'll email me at my personal email, tmelvin@gmail.com, I'll send you the links to the current offers that we have going on for the newsletter and how you can get a copy of the 10 Tiny Banks book if you want. There are safe and cheap stocks out there. Not as many as I'd like to see, but all of these are priced so cheap, the upside just looks enormous to me if you're using that private equity mindset and think like a long-term investor and not a short-term trader. So anyway, it's a very short week. I believe we close early on Thursday, and then we jump right into the good old 4th of July holiday on Friday. One of my favorites, a big party here in the neighborhood down in Central Florida. We're going to have fireworks and barbecue and all kinds of stuff up by the pool. Going to be fantastic. I'm going to do a great job of wearing out a red Solo cup, I'm sure, at this little celebration. But it's going to be a good time. I love the 4th of July, one of my all-time favorite holidays in the blistering hot of summer. But it may be a short trading week. There's a ton of information coming at us this week, folks. We've got the ADP numbers. I don't know why anybody cares. Does not seem to be correlated with anything under the sun, but we're going to talk about them, and it might move the market around a little bit anyway. You do have followed up later in the week with the payroll report, and that one is an important report to see if we've got any job growth. What I'm really looking for to see to say, yeah, it's getting better, is I want to see the number of full-time higher paying jobs begin to creep up. Haven't seen that in some time now. Janet Yellen's going to be allowed to speak at an IMF conference, and everything she says can move the market this direction or the other. So that will be interesting during the week. We get construction spending, and for the reasons we just talked about, I'll be watching that very closely. We also get the ISM numbers and the Chicago Purchasing Managers Index. So it's a short week, but it's going to be a busy week. There's a ton of numbers coming at us. So we'll see if any of this moves the market around and gives us an opportunity to sell something at a huge profit, or hopefully we get an inventory creation event and we can really start to get some money to work over the rest of the summer. Anyway, on the book front, not much out this week that caught my eye except for a new Max Allan Collins mystery. He's a great noir-style writer that I've followed for years, but July is going to be busy. We have new books from Stuart Woods, C.J. Box, John Sanford, Ace Atkins, Brad Thor. There's a Neil Armstrong biography coming out that looks really interesting to me. I was fascinated by the space program and the moon landings when I was a kid, and it stayed with me all my life. And now my 11-year-old is also very into the cosmos and the universe and the whole space thing. So it should be an interesting book. Not much happening on the business book front right now. Everything that I look at, and I flip through, and Amazon sends me updates and whatnot, it's all in the be a great leader while day trading your way to fame and riches classification. I don't have a lot of interest in those type of books. So I think we're going to have to sit and wait for any new books to come rolling our way. But in the fall, we got a couple good ones. Tobias Carlisle has one coming out on deep value. Guy Spears' Education of a Value Investor should be a great book. And then Christopher Ross Grill, who wrote There's Always Something to Do, the excellent Peter Cundall book a few years ago. Excellent book, by the way. If you have not read it, get it on your list, download it on your Kindle, whatever you got to do, get the book. It's really good. He's coming out with an enhanced look at the life and career of the legendary Canadian value investor. Great title, Routines and Orgies, The Life of Peter Cundall. Should be a fantastic read. I hear something well over 600 pages long, just a real in-depth look at his life, his approach to the financial markets, and should be a great read for all of us value investors. But until the fall gets here, I'm afraid we're a little thin in the ground. You'll have to stay with the classics. Anyway, Orioles, one of the hottest teams in baseball right now. We've won 7 of our last 10 games. We're split with Tampa Bay yesterday, playing them this afternoon, and then got one more with them tomorrow, and then Texas and the Red Sox come rolling into Baltimore, and we'll be watching it on MLB.com, and should be a great week of baseball ahead. That's pretty much all I've got this week. We will talk to you guys next week after the big 4th of July celebration. This is Tim Melvin of the Deep Value Reports and Banking on Profits. I'll talk to y'all next week.